I'd like to share with you a few thoughts on why market fluctuation isn't necessarily a bad thing. It's come to our attention as of late that our desire to see the market consistently grow may or may not be such a good thing. So what we've done here is I've come up with a very brief example. It's all hypothetical, but I think it'll prove the point. That we have one scenario right here where we took a 20-year period and we showed the market growing consistently at 10% a year. Sounds great, right? Who wouldn't like the market to go up 10% a year? We did that consistently. We started with an initial value of $100,000. It was all in stocks that paid a dividend. The initial dividend was 5%. Okay? And we wanted to show the effect of what happens on a portfolio value and the dividend if we see a time period where the market just goes up consistently. So what happened is the initial value went from 100,000 to 672,000, growing at 10% consistently every single year. Now, if you add in the dividends that it earned over that same period of time, the actual value went from 100,000 to over $1 million at a consistent growth rate of 10% over a 20-year period. The annual income on the 21st year would be $7,931. Sounds great, right? Yes. Who doesn't want the market to continually go up? Scenario B is more real world. Actually, it's an accentuated real world, where we had a bunch of bad years and a bunch of good years. So we showed 8 down years and 12 up years. Okay? It did not consistently grow at 10%, yet the average in scenario 2 is the same 10% a year over 20 years as the first one did. But the first one just earned 10% a year every single year with no fluctuation. The second one was more of a fluctuating road where it went up maybe 10% in a year, went down 10%, and then went up maybe 20%, down 5%, so have you, over a 20-year period to average 10% per year. Now, what's interesting is the growth over the same period of time was exactly the same, but when you add in the dividends, taking into consideration that there was losses, what happened is the now total value went from $1 million to almost $1.3 million. The reason for that is because we got to buy shares of stock when they were on sale. When the value of that stock went down, we were able to reinvest those dividends. What you're going to see here in this chart is this blue line represents the consistent market growth year over year for 20 years and us buying. Now what happens there is we were always buying at a premium. As the market went up and never pulled back, we were always buying at a higher and a higher and a higher price point. What happened scenario 2, which is this red line, is the market would pull back, the stock values would go back, we'd buy them on sale, and then when the market would come back up, the stock values would come back up, the value of our account exponentially grew faster. Okay? That's why we could go from a 1 million total value in 20 years with a consistent growth market to a nearly 1.3 million total value by buying when stocks were on sale. Now let me go over a few statistics with you. What happens here in the S&P 500, if you look at it as a whole, it averages about 10%. That's why we used 10% growth rate on the S&P, or in that last example. Now what I want to point out to you is 42% of that earnings, that 10% average, comes from dividends. Dividends are obviously a very big part of what our firm does. It's a focal point of how we generate income. And 42% that is represented every single year on the S&P total return comes from dividend income. Okay? So if we look at our portfolio statistically to start this year, the average stock in our portfolio has consistently paid dividend income for 59 straight years. Okay? The average stock in our portfolio has not only paid for 59 years, but it increases its dividend for an average of almost 18 years in a row. So that means last year they paid a little bit less because they raised their dividend this year. Next year, statistically, we can state that the average stock in our portfolio is probably going to raise their dividend income going into next year. We'll find out. It started at 3.9% dividend. When we bought into our portfolio in January, you had an average of 3.9% dividend income. That means for every $100,000 that you have in our income portfolio, you're generating $3,900. Now we've transitioned over into our 2018 portfolio. We sold about 7 stocks. We bought 7 more stocks to replace it. Here's what happened. Our consistency of paying dividends went from 59 years to 56 years. We lost 3 years of consistency. But in the grand scheme of things, it's still 56 years. Now what we gained is an average of 2 more years of consistently paying increases on their dividend, which is very important. Who doesn't want a pay raise on their income? But the most important thing I want to point out to you is that the dividend rate went from 3.9% to 5.4%. That is a 35% dividend increase, and it happened immediately. So the income on your portfolio now is generating $5,400 as opposed to $3,900. If we go back to the chart that we were talking about earlier, that's where this plays such a dramatic role in your future. I understand we talk a lot about value, and value is very important, but value is nothing more than a snapshot on the timeline of your total portfolio. And there's going to be some times, some months, some years where that snapshot isn't impressive. When we look at our value, we're actually pretty upset. But in the grand scheme of things, if we hold to the philosophy, we can see over time that we're going to have substantial amount of more shares, more value, and more income. And that total value of income increase, if you look at the chart here, it's 25% more. So that means if we can just hold on when it doesn't look so pretty, okay, when the market goes up and we go up less, or the market goes up and we go down, or whatever the scenario is, if we can hold on to the philosophy that proves to be true in an up and down marketplace, there's a great chance we're going to be significantly further ahead in the future. Okay, so the whole point of this video is too much of a good thing can turn out to be a bad deal. Because if we have consistent growth year over year, which everybody wants, myself included, mathematically, it actually turns out to be a bad thing. So the next time the market goes down, or our portfolio underperforms, or things don't turn out the way we want in a given month or time frame, long term, that's not necessarily a bad thing.